Hello, welcome to this short video on investment strategies. Thanks for tuning in. So this short video, the point of it is to outline investment strategies and decision making, how investors make decisions when they've got two or three or more opportunities, which is almost always the case. First slide here deals with investment strategies. It's really important because we use this lingo all the time in real estate industry. To know what core plus, value add, and the lingo now is spec. We don't want to say the whole speculative or opportunistic approaches to real estate investing. So these are largely borrowed from the wider realm of finance. They are almost interchangeable. Core assets. They mean an investor that wants passive income. They don't want to put capital into the investment during the investment period. So what are they buying in terms of commercial real estate? They're buying the stuff straight from the developer. So a developer that has a develop and sell strategy, their customers, the buyers of their assets, are core investors. These tend to be pension funds with defined income liabilities. So they want secure investments, low risk, with defined income streams. That's a core investor. So a typical balance sheet for a core investor is purchase followed by years of income with a sale at the end. Who are they going to sell it to? Remember, a core principle of commercial real estate is that the value of it declines over time. The value being the potential to earn future income, or the relative market position of the asset. Core investor holds it for 10 years. New developers develop newer assets, better space, and they tempt those tenants in the core assets away when those leases expire in the core asset. So 10 years later, the building is depreciated, and it's started to become relatively obsolescent with new stock in the market. So the buyers could be core plus. So this is a sort of a real estate somewhere in between value add and core. So this is an investor that buys an asset, generally keeps it in the same sector, and does touch-up type renovations. So they're looking at an asset that's depreciated, but is not necessarily obsolescent. So they're going to come in and do a lot of renovations and refurbishments that aren't structural or major. So largely done with tenants still in place. So low-risk type improvements to the asset. A more typical active investor is a value-add investor. They're seeking capital gains and capital returns. So they're buying an asset, often a distressed asset. They're going to improve its market position and either continue to hold it with the new income streams coming in or sell back upstream to a core investor if the market positioning of the asset succeeds and the income earning capacity improves. So value-add investors, right? You can kind of think of them like developers. They tend to, again, keep the asset in the same sector. So they'll buy say a B-grade office building, and the plan is to invest capital into that building to move it up to an A-grade and improve the rents and attract better tenants and higher income. Now, what differentiates those value-add investors from spec investors is that spec investors tend to go in on the deal with a very high risk. Maybe they're moving to a different sector, complete demolish, rebuild. So they're taking a completely distressed and obsolescent asset and converting it into a productive asset, often without a specific tenant or use in mind. So they would be considered speculative or very high-risk investors. So they're doing a really high-risk renovation. The other terms on the slide, sector-specific, those are very specific strategies that investors can follow if they have expertise in a specific area or knowledge in an area. Key takeaway here, the diversity of investors in the market creates the market for real estate. So core investors at the end of their life are often selling to core plus or value-add investors. On improving the property, value-add investors make an asset attractive to core investors again. So those investors have different expertise. Core investors are not experts in redevelopment. value-add investors are, but they probably aren't as good at ongoing property management as your core investors are. So that diversity creates markets. Now, how do these investors make decisions? So two key, what we call simple financial feasibility analysis, is the NPV and IRR methods of decision making. So NPV, net present value. If we know the asking initial price, oops, sorry, let me go back. I skipped a slide somehow. Present value, this uses the DCF approach. So investment valuation always with DCFs using a pro forma. We're not using income capitalization anymore. That's good to get an estimate of market value. Investors do full DCF. So present value, just like we saw in market valuation with a DCF approach, present value of all the future cash flow streams on the balance sheet. For an equity investor, we're always looking at hurdle rates. Remember, you have to discount the future cash flows. For an investor, we use their internally derived hurdle rate. Now that should be very similar to the one that is in the capital markets for a given level of risk. However, key thing here, because we have a diversity of investors in the market, each investor might have different perceptions of the risk associated with the cash flows in that asset. So perhaps one investor has inside information about a potential tenant in a property that's vacant. Their risk expectation is going to look a lot less than an investor that goes in seeing a vacant asset with no idea who could possibly occupy that space. So the two investors, same asset, different expectations of risk, which means different hurdle rates. Now, those hurdle rates are largely going to be on the equity cash flow lines. And we're going to learn about these equity before tax cash flow, or if the investor is subject to income tax, equity after tax cash flows. So NPV is where they take the market value. Remember, investors don't pay anything different than market value. If their investment value is higher than market value, they go try and do the deal at market value, or else they're the greater fool. They've given away a lot of their return right off the bat. So you take the market value, subtract that from the derived investment value in an unleveraged context, and you get the present value. If that's greater than 0, deal. Or equal to 0, deal. That just means you're earning that hurdle rate. Success. So NPV 0 deals, great. In fact, an efficient market, every deal is going to be NPV 0 because everybody's got the same information. If the NPV is less than 0, no deal. So in that case, the hurdle rate, whatever determined that hurdle rate, is better, whether it be another real estate investment or moving that capital and investing it in a different market, share market or the bond market. The other decision-making tool, internal rate of return. So same idea as DCF. However, now we add in the market, the purchase price, what we bought the asset for, or what equity we have to put in the deal if we're doing the IRR on the equity before tax cash flow line. If that IRR exceeds our hurdle rate, deal. If it, or equal to our hurdle rate, deal. Great, we're earning a hurdle rate. If it is less than the hurdle rate, no deal. So reject the project. I put a note in here about debt. Remember, I like to think of debt as an investor. Their IRR is going to be the same as the effective interest rate. So the interest rate of the loan accounting for all of the fees associated with that loan. Now, last point. IRR and NPV, these rules, you think, well, they're always going to be the same, right? No. Mathematics, especially with negative numbers involved, means that they can disagree, especially if you've got a dog. If you've got an asset that's losing tons of money in the future, the discounting formula is going to look and try and discount the negative cash flows at a higher rate. Because what the math is trying to do is make the negative cash flows equal to the positive cash flows. If the negative ones are a lot bigger, suddenly the bigger numbers, the bigger discount rates are associated with trying to get the negative liabilities to the investor as small as possible. So, here's an example. How can you profit by losing an extra $2.5 million? So take a look at these two assets. if you just looked at the IRRs, you'd think, I'll take asset B, thanks. But look at those cash flows closely. Look at year 4. A makes $1 million. B only makes 500,000. Year 5, A loses 2 million. But B loses 2.5 million. Year 6, B's losing 550,000. B is losing $1 million more, 1.55 million. So asset B has lost $2 million more in nominal terms than A, but yet has an IRR over double A. What happened there? Well, B is so bad that the math has to discount the huge negative cash flows at the end by a high number, in this case 48%, in order to make it balance the present value of those those very few positive cash flows you get in years 2 and 4. So IRR can often mislead, and although it's the #1 used tool in the commercial real estate industry, if they do disagree, NPV generally tells you what's going to maximize wealth the most. So when they disagree, try and default to NPV. Thanks for watching. See you next time.